end up getting, we might get 50 people, but we'll start.
Okay. So I'll go first. Abhay, Ashutosh, thank you so much for joining us today. Maybe we can start with just your broad thoughts on what's happening in the market. What are you seeing? And we'll deep dive into some of, Sahil and I do have a long list of questions. But if you could just start off with a quick, your broad thoughts.
Cool. Maybe I can start with the sort of very top level macro, Shruti. I think as we sort of think eternally as to how we should behave in this situation, there's a few things that we look at, and these have been very long trending phenomena, and there is three of them. One is cheap money. It's been around for like 30-35 years now. The second one is cheap labor. There were certain countries from which people could import, and the price of TV kind of continued to keep falling over the last many years, which is an interesting phenomena. And then I would say sort of the last one is the relative openness. So everyone was on this path of capitalism, which is to say we'll be more open, more free, more globalized, all of that. And I think all three are reversing in some way, shape, or form. When you look at previous soft macros, it was one or two things at max that were behind that macro, right? If you look at sort of housing bust, mostly because of cheap money. If you look at sort of .com bust, also cheap money. And so when you have one or two variables to play with, you kind of it's easy for central banks to wriggle out of that situation. Now, when you have more than one, more than two, more than three, more than four, it's very difficult to predict where, when, and how this will land. And therefore, this is like a cocktail. You probably don't know what's in it, and so you can't predict what the hangover will be like tomorrow morning. So I think we are in a tricky situation because of that. Now there is some black swans. If there's a settlement that happens in Europe, if China kind of starts behaving the way they used to behave like a year or two ago, we could be in a different situation. But for now, it seems very tricky. It's very difficult to call how long this lasts, and therefore I think the guidance to portfolio is to be extremely careful and extend the runway as much as you can. Abhay, please feel free to chat.
Ashutosh, एक छोटा सा question था. Lot of founders are imagining that on 10th of January they will go to the market with the decks, and it's 2023, so they'll get funded. How likely is that? मतलब they are saying कि 2023 में हो गया, आपने बोला था कि अगले साल होगा, तो अब तो आ गया अगला साल.
नहीं sir, अभी इतना short term में तो I don't think anything is happening. So look, I think again people take hope, right? I mean it's human nature. In times of little bit desperation, sort of any flatlining of inflation or Fed not hiking by 75 but 50 basis points, this is the peak we're done. But what I'm saying is that maybe a part of it has played out and kuch aur aayega, uske baad kuch aur. There's so much happening, there's so much volatility around that you don't know if ye peak hai, ye trough hai, ye temporary peak hai, temporary trough hai, kya hai. So I would, like, if I was a founder, I would not plan for that.
Okay. So probably hold out at least till 24, you're saying, at least extend the runway 12 to 18 months from today.
Easily. I think that's what we should plan for. And I would, what I'm also saying is that you have to have a plan A, you have to have a plan B, and you also have to have a plan Z, which is like end of 23 also, we don't know, right? And if that's where we are, then there has to be a plan Z. Existence is paramount then. Yeah.
No, Ashutosh, you gave the nice overview economist answer of what's going on. I'll give a more so-called the practitioner answer of what's going on in our lives. And I see a lot of pain both in companies and funds, none of which is apparent yet or being spoken about explicitly yet. And over the next 6 to 12 months, we'll see a lot more of that real pain, which will be felt both by funds and entrepreneurs. Of course, all of this excludes the top quartile of everything or top decile of everything. They'll not get affected. But outside of that, there'll be serious impact. And already seeing some of that play out in the first set of companies that are going to raise capital because they need to. And similarly for funds, you will have to extend your runway. There isn't a choice. You'll have to slow down the pace of investing because the visibility of when the next fund will come, the 18-month cycles or even the 1-year cycles that had become common in 2020 and 2021 are gone. So everyone has to think accordingly. Save money, extend the runway, which again is a vicious cycle because if funds start saving money, it gets harder and harder for the entrepreneurs. And in at least the last 15 years of my investing, I haven't seen, let's rephrase the other way. Every fund probably has more capital than they've ever had, but everyone is more careful than they were ever before. The outside language will be that we are open for business. We are leaning forward. We like these situations. We like the downturns because we can be more active. But there'll be a little bit of fear saying, oh, I don't know when the next fundraise will happen. So let me be a little bit careful. And that will make the IC discussions harder. You as analysts will take companies that you think are, ye to achhi lag rahi hai, ye to last year approve thi aisi company, but abhi kyun nahi approve ho rahi hai? Now suddenly people, the hurdle rates have gone up and suddenly the partners are saying, ye kya hai, ye check karke aao, wo check karke aao, all of that stuff. So the bar just goes up not because the company is not as nice as in 21, but because people are more worried about how fast the capital may go. Again, exclude the top 10% funds from this. And companies, I think it's the double whammy because the Indian funds are careful, but Indian funds still have the business only in India. So they have to invest. You can extend your runway from 24 months to 36 months or even a little more. But the foreign inflow is just dried up. And that is going to have a more massive impact. Of the $35 billion that came in last year, I would assume closer to 20-25 billion would have come from overseas, not the funds domiciled in India, the Sequoias and the Accels and the Lightspeeds, not just that. So there is the pain will be much deeper for entrepreneurs than the funds, but it's across the board.
So Abhay, just taking from there, like, is there any fundamental shift in terms of like the runway? Say you invest in a loss-making company, you might have factored in, say, a 5 to 7 year kind of path to profitability earlier. Have you reduced that to 3 years? Is there such fundamental metrics change apart from, say, longer decision-making time frames or increased hurdle rates or lower valuations? So any fundamental metrics?
I think the one set of companies which usually are possibly some of the largest outcomes, think Swiggy, think Flipkart, those kind of companies which target very large markets with an undefined of money required to capture that market. Those will be the hardest to get done because today, I mean, in a nice cycle, people have the appetite of saying, hey, you know, this is a very large market getting tackled by a very good set of entrepreneurs. Let me put 25 million here and then another 50 and another 100 and then 300 and 500 because you're all chasing a large outcome. And then usually happen that those get more and more difficult to fund because no one knows where the next 50 and the next 350 is going to come from. There are fewer pockets for that. The easier ones are companies that are built with $50 and $75 million because you can see where that money is going to come from. That's visible. So I think the indefinite amount of money required is the harder ones to underwrite as we go ahead. Within that, adjustments on every company will happen. So if us as A91 were saying that I'm okay if the company makes losses for the first 3 years and then need to get profitable, you start saying, hey, today I'm getting a profitable company. Why not do that at the same valuation or at a reasonable valuation? Let me buy into that. Why take the risk of 3 years of unprofitability? So things like those will happen. Those are minor adjustments, but I think the bigger adjustment will be in the former thing that I said.
Abhay, the corollary would be that, you know, the current companies are still not profitable founders still are going to try once in the first half of this year before accepting कि fundraise नहीं हो रहा है. ये तो पक्का है. Well, I take like 90% of the founders will say कि boss, I will try once, only then I'll figure out profitability or reducing burn really. People have done 10-20% cuts. But as an investor, would you say कि okay boss, people haven't started becoming profitable yet. I'll wait till then.
No,
before getting in.
I think all of us, and that's true for every fund, you want to see a direction now. You don't want to see profitability.
You want a good, strong direction, right? Not a 10%, 20% cut.
Yeah. So if you can show me that you were minus 40% and now you are minus 23% and next year you'll be minus 12%, I'm okay with that because I can see a trend. But if you're minus 40 and minus 57 after that, I said, thank you. It doesn't work. I don't know where you're going. So the problem is going from minus 40 to minus 23 oftentimes requires a growth to slow down from 100% to 20%.
Correct.
And then you start wondering, what do I do with this? I'm not in for a 20% growth. I want 60% growth. And that is a challenge that is a bigger challenge that most entrepreneurs will face because reducing burn can still be done. But you can't have high growth with reduced burn in most cases. There are very few companies that will be able to manage that.
I think the only thing I'll add is, Sahil, to your question was that look, it depends a little bit on the stage of the company as well, right? If you take those two examples, Swiggy and Flipkart, I think they have levers that they can pull to get to that profitability, and therefore, in the short, medium term, existence is not an issue for them, right? And both have raised, fortunately, in the last year as well. So I think that's the other thing that's happening. But if you are a Series A company, right, you don't have a choice. You have to spend on product, you have to spend on GTM, you have to spend on sales, you have to spend on marketing. So I think in India, at least, I think that's where the sort of early realization will happen. That's where you will see the first multiples softening. That's where you will see
at Series B, you're saying.
At Series B, a flattish rounds happening. So it little bit depends on stage as well.
Got it. Ashutosh, makes sense. I mean, with respect to the stage being a key factor here, what about sectors? Any specific sectors you think will see more gloom, or maybe sectors that require less of fundraise to get to a Series B kind of a milestone?
No, Abhay already answered that question perfectly. Look, if you are in a sector where you need to burn $20 million a month, I think this is a difficult time to start. You should not start. But on the other side, if you are in a sector which is sort of, as he said, with 60, 65 million, 70 million, if you can get to a stage where you either become self-sustaining, or you sort of are ready to list, or you get to a scale where some other kind of exits is something that you can explore, I think then it becomes, those sectors will see affinity. And what kind of sectors are probably like SaaS is a good example of that, right? Consumer brands is a good example of that. And that's there. The other sectors which are sort of less related to macro, but more related to tailwinds, right? And I think EVs is one example. In this country, our biggest problem is our crude oil bill, right? So if there is a way to, and that the effect of that is not just being seen by the government, but by us as people as well, right? So, and I mean, there is a way to then sort of move away from that. I'm sure government will also be very supportive. I think that will see some action for sure. This sort of whole China plus one kind of a thing, I mean, it's a golden opportunity for us as a country. Unfortunately, it just takes so much longer to build that infra to become supply enabled to the world. But I think there also there is enough interesting action that could happen. These are the two tailwinds I see, I think, in times of headwinds, I would say.
Yeah, I mean, I think a general framework for this is in times of scarcity, you dream less. So you'll not dream of the $20 billion outcome. You'll think, if I wish my company, I'm investing at, let's say 50, I'm very happy if the company gets to 500. So let me look at a range bound outcome. I don't want too many losses. Let me reduce risk. Lower upside is okay. When you're flush with liquidity, you dream more.
Abhay, related to the sectors, both of you could answer this. there is also a phenomenon we saw last 2 years that people were starting and getting funded for the number 5, number 7, number 9 players in the sector. For example, in grocery or a few other verticals, and in marketplaces also same thing happened. And SaaS, it keeps happening. So while SaaS appears to be a safer, relatively, sector, but is it possible that people will stop funding the number 5 player or number 7 player in each of these sectors? Or if it's a safe sector, people will still fund the 57th CRM coming out of India? Just asking, like.
I think that your question has the answer. You should not be funding that, but I think it depends.
No, I don't know. It could be, right? Because it's not like there is still a business for those. I'm not saying that a number 5 SaaS company in a category would still make some revenue because there will be some nuance, there will be some access to market. But will that dry up, or you're saying that's okay?
It gets harder and harder, Anand, very simply.
Harder and harder, right?
Because it's one thing. I mean, you at the seed series A stage will say, can I see this company get to 10 million? I will start saying, can I see this company go from 10 to 50? And somebody else will say, can I see this company go from 10 to 100? And it's not possible that 50 companies or even 10 companies in the same space from India will become $100 million. And if you can't become $100 million, why are we doing it?
Yeah.
So that question, that lens will be sharper. And when you do this at the seed stage, you're not just saying, hey, I'll hand this over to someone and I'll move on, because that's not exit for you. It's just a markup for you. And those days of feeling happy about markups are gone. You have to think more of the company.
That should be a specific discussion.
Yeah, I think I agree. I think the general sentiment in most ICs, most partnerships at this time is that the bar is high. And so, and this is just sort of one input to that bar, right? If you're number 5, number 6 company, unfortunately, you will not hit that bar. If you are a high burn company, unfortunately, you will not hit that bar. If you are an either or company wherein you either can show economics or can show growth, unfortunately, you will not hit that bar. If you are a company which is where the future is 15 years out, unfortunately, today you will not hit that bar. So I think that bar is the holy grail, I would say.
Yeah, Ashutosh, so I get a pushback from founders. Here, there is a lot of dry powder. So how are both of you thinking about dry powder? Dry powder theory बहुत चल रहा है.
Yeah, no, वो fair है, sir. So I think that's where next 2 years will be 5 years out, when an economist will do a sort of deep dive or will look at this in the next 2 years. I think there'll be so much data, so much interesting trends that it'll be beautiful for sort of post-mortem kind of a thing. And dry powder is one reason, right? And what will happen is that we will have, my guess is we will have a bunch of these sort of false starts a little bit, right? So you see something going in the right direction. Oh, say, chalo, kar do yaar, 4 deal kar do. And then like next month you see, oh shit, no, this was not the nirvana that we were all thinking of. This is again sort of back to something. And then sort of people pull back. So lots of starts and stops and starts and stops. We'll see, my guess is we'll see over the next couple of years. So while that dry powder is there, but look, you don't want to deploy when the next round is not clear, right? अगर आपका ही कंपनी हो, आपने 6 महीने के लिए आपने पैसे दे दिए, but you're not sure कि यार 6 महीने बाद रेज हो भी पाएगा कि नहीं हो पाएगा. अगर नहीं हो पाएगा, then you would rather say, boss, let's wait, देख लेते हैं, फिर करेंगे. So yeah, that's.
I don't want to hog the question.
Just one more point to add here, and so flow of investments or pace of investments from any fund is a function of dry powder and what you are seeing likely exits as. Because you're in the business of deploying and returning for the established funds. I think the second one has gone to zero or close to zero. So of the 2 factors that determine your pace, one has gone away. So that factor starts driving a lot of your pace, saying, hey, if I'm not able to return, I should not be investing very fast. Again, exclude the top 10% funds because they don't care about all this. And funnily enough, in life, every 30% of the funds think they're top 10%, so that's helpful. But otherwise, if you are a middling fund, you'll say, I'm not able to distribute. If I keep investing and I go back to my LPs in 2 years' time, they will ask me many questions. And today we find some funds in that situation where you're saying, show me the results and exits from that fund and whatever else. And you say, hey, I have markups. And that worked in 21, but today it will not work.
Just one small comment away on how are you thinking of bridge rounds? Because same dry powder that you have is visible to your own founders also, right? I'm sure they're also eyeing it. Will I?
That's true. That's true. But there you have to be, I think the good news is most funds are disciplined on cross-fund investments. So you have to be very transparent with them. And that's good discipline for funds when you invest, saying, hey, this is my reserves for you and I can't go beyond this. If you push me, I can do another so much, but that's it. And now I'm on my next fund and I can't go from this fund to that fund. And therefore now this is for the next set and that set is new. And so if you're disciplined and doing it the right way, you should be upfront. And
okay, in a multi-partner setting, how is discipline maintained around these decisions, internal bridge rounds?
I think no different from investment decisions. You sit down and again discuss this. No, there should not be multi-partners means everyone is a partner. So no one partner should be pulling saying, hey, main bol raha hu.
Okay. Good point. Right. Okay. Sorry, Shruti. I hijacked there.
Ashutosh and Abhay, just one thing on the fundamental metric change that is on the business. But what about the metrics on founders? Like in last 3 years, given many are pretty young founders, they have a very different frame of mind, right? Like ultimately you have to deliver profitability. That might not be a thing in the mind for them. So how are you indexing those kind of parameters? Will there be any shift in that? Because I think that's something also more fundamental, which may change, might not change.
Yeah, interesting question. I would say that, look, this is more a mindset thing, and I would, age has less to do with this. I would say, I think some of the filtering is already happening, Sahib, because whoever is starting at this time has kind of internalized that, look, I'm starting now, is probably a very high conviction founder, because unless they don't have that high conviction, it's very clear to them that, look, this is a tricky time to start. And therefore, someone who was sitting on the fence and just because of the frenzy in the market ended up starting, I think that you won't see anymore. And so I really honestly think that I personally don't worry about it. Of course, as part of our diligence and all of that, we really try and gauge as to what the mindset of the founder is, what the mindset of the founding team is. But the environment is already doing some basic level of filtering there.
I just had one. I mean, the founder characteristics don't change over time. The relative importance of what you think, you weigh and assess at any point in time may change depending on the environment. We were just coming out of the longest bull run the world has ever seen between 2010 and 22, where we had forgotten a little bit of what founder resilience means, because founder resilience is not tested in good times. I think as we head into, let's say, the next 12 to 24 months of tough times, the lens on resilience, have they demonstrated something? Have they come out through tough times? Have they seen scarcity? Have they seen some real trouble in life? That lens may be sharpened and people may apply that a bit more, that relative importance of that may be higher.
Right.
Abhay, Ashutosh, maybe a slightly more generic question, but let's say there's a founder who's now somehow managed to get himself 12 to 18 months of runway. What is a good way for them to stay engaged with potential investors without getting into active fundraising mode?
Look, one, of course, you have to be slightly selective with who you want to engage with, right? I mean, founders' time is super precious. And so I'm not a big believer in these sort of quarterly meetings and update meetings and all of that. I think best is to provide, and this in my case has worked very well, sort of best is to provide sort of an email kind of an update once a quarter Some of them do once a month also with some highlights of the business. It's always good to provide a couple of lowlights as well, so that someone can make. And I think that's a great way for me to say that, dude, this is a good time for me to engage. So that's on a sort of generic level. But if there is a couple of funds or a fund that you're really keen on, I think in those situations, I sort of really advise sort of basis the last meeting that you had with them, and for whatever reason they didn't invest or past, I think there you should get very good feedback, very detailed. You should always get feedback, but there you should get very detailed feedback as to why this did not happen. And I think if you are able to answer those questions over the next few months, I think always good to send a very pointed email saying that, look, we had a debrief and you said these two things, and I'm done with it, and look, yeah. So I think that's, yeah, it's a very fine balance that that people need to have.
Yeah, no, that's a that covers it. In my experience, good founders start sensing who are the investors who are showing some interest, and therefore they start spending disproportionate time with them, because you can waste a lot of time with 20 investors, but say, here, you know what, these 3 guys are the ones who've been asking the right questions, who are seeming to be really interested in my business. Today, in fact, we're in a bit of a funny situation where founders are not even saying, I'm doing fundraising. They're almost reluctant or shy to say we are fundraising. They say, let me catch you for an update. And which is okay, because we all have time right now. We always have time, but right now we may have more time. To engage in informal conversation with many funds, and then funnel down to saying, here are the 2-3 guys who seem to be having a thesis in my industry, seem to have done something, are curious, are asking the right questions, and then keep following up with them with some updates, as Ashutosh said. So that's the right route, always. And gone are the days where you could expect a surprise investor who'd come and give you 100% markup was a fair value. Today, most people are coming in a very narrow zone. We just ran a process for a Series C for a company, and 7 term sheets, all within 20%. So then it's more important that you figure out who are the people you want to work with. I mean, 10-20% band is, you should choose the investor versus the valuation. So you start with the other way around, choose the investors who are showing more interest, and it's likely that if they are liking it, you will get within that narrow band and close it, because that's more important today, closure versus maximizing.
Got it. Guys, please feel free to chip in with the questions. Maybe I'll take the next one as well. Abhay, you mentioned about how, from decacorns, now we're looking at 500 million outcome, 1 billion outcome. But let's say, you're typically at a, say, 8 to 10 year fund life. And by the time we actually start taking exits, the market may change again. So, looking at a 500 million outcome, is that enough, even in this kind of a market?
I mean, if you are consistent, it's enough, but we along the way make many mistakes. So sometimes it's not. See, a 500 million, depending on the size of the fund, of course, and what stage you come in. Yeah. At least where we operate, which is a 25 million check, typically, where you try to buy 15-20% ownership, which means you're coming in around the 100 million plus a little bit valuation. 500 is a very decent outcome. But really important. And if you're talking about a seed fund or a Series A fund, 500 should be reasonable, as long as you're not hitting more than US loss rates. I think in general in India, over the last 10 years, there are very few companies, which are genuinely worth more than 5 billion. So we should not, the 1 to 3 billion outcomes are actually very, very good for India where we are today, and probably applies for the next 3-4 years. I mean, I was in an LP meeting recently, and the LP asked me that how many companies in India today are generating or likely to generate $500 million of gross profits over the next 2-3 years. And I said, why do you ask that? He said, if they're not generating $500 million of gross profits, they're not worth 5 billion. I said, I can't think of any right now. So he said, then none of the companies should really be worth 5 billion. I said, maybe, but there's growth and there is quality, etc., market opportunity. That's fair enough. But in general, if you're not hitting in that zone, you should not be worth that much. And there's very little that's even heading in that direction. I mean, I know there are companies who are 22 and 15 and 17 and all that, but when it comes to the financial metrics justifying that valuation, it's not there. So in any way, any case, it's very hard in India to target the decacons. No one knew that you would be a decacon at the time of investing. That the investment case was made for probably $1 billion company, and that was a very good. Along the way, things happen. So I think when you start with 500 in these markets, it's pretty good. If you find $1 billion kind company today, you are doing very well.
That's I think everybody understands the hard part about India. Nobody dreams of decacon, for me at least. Benchmark is a $1 billion company, although I wish we create a alphabet out of India also. But just given the scenario, what do you think early stage investors are doing right or wrong? Because there is a frenzy. Like today, I see my friends, some B school classmates or IIT fellows. Like generally, there is 3-4 million just based on the idea, right? Sometimes they are experienced, sometimes they don't. Because I'm like generally they brainstorm with me, so I know like sometimes there is no kind of deep brainstorming also, to be very honest. But given whatever the dry powder is there, the capital still seems to be available to a certain extent, maybe dwindling. So, but what do you think has been going right or wrong in the early stage part of the ecosystem, and how like all the participants here could factor in to be a better professional?
I think probably Anand is best suited to answer that question. Amongst all of us. Anand, go ahead.
Hey, Sahil, can you repeat?
Anand has voiced his opinions in multiple forums. I was saying what was going wrong in the input funnel or right in the from the early stage part of the ecosystem.
I
So,
think
Anand,
Abhay nailed it in the
rephrase
beginning.
this.
We were calling up rounds and markups as success, right? And in the interim, thoda bahut false signal mila because there were some exits in those markups, right? That gave another false hope. But it's not possible for a fund who owns 10, 15, 20% to exit meaningfully in these up rounds, and that should not be the strategy also. So that's sort of what I feel. So early investors were not buying in for a 10-year horizon into the company. And that's part of it. The other part of it that is that probably early investors were not as involved in what was happening in the company. Thoda hands off ho gaya tha. Okay, just leave it to and hence sort of the oversight went away because bulk of your Series C, D investors were abroad who probably didn't even know what's going on in the company, and the Indian guys were sort of okay. I also feel that the relationship between the founder and the early investors sort of broke because some investors would have tried saying, let's not raise so much money, let's not spend so much money. And the founder would have said, pushed back and saying, what do you know? You're not even participating or meaningfully in this round. So I think all of that happened. I initially blamed it for first few months to COVID, by the way, not the bubble. यार सबका दिमाग खराब हो गया है COVID में, तो ये सब हो रहा है. So I don't know if I answered your question.
I mean, at least from where I observe, I think a lot of early stage investors forgot they were investors. They became investment bankers.
Yeah, exactly. Yeah. Drumming up the companies.
If you go back to the core philosophy of, I'm going back to Don Valentine of Sequoia, who founded Sequoia. He used to say that I do not invest in a company which is more than 15-kilometer radius from my office because I want to be able to drive to that office within 15 minutes if the founder calls me. And why this is important? Because the only reason he's taking money from me is because I can help him, and I can help 5 to 7 companies at any point in time. That's what I should do. That's my job. I think the job of the venture capital investor or the early stage investor in the recent times has become, let me find a company that Sequoia will like, or Tiger will like, or SoftBank will like, and let me now start singing praises, tweeting about it, helping in presentations to raise the next round of capital. As long as the next round of capital is done, raised, my job is done. Let me move to the next company. And that is doing the biggest disservice, because in most cases, a Tiger or SoftBank may have been the worst investor for that company, because it may have been going on a right path by flooding them with capital. You may have spoiled the company's DNA, and you thought you did your job very well.
Abhay, this is an important role of the early investor, because they should have a clear view on what is the likely outcome, and hence try to match the right investors with that size of the outcome.
Absolutely.
So that mismatches they couldn't control.
Absolutely. For this company, I want to go to only, let's say, from your point of view, I want to go to Axel because they understand SaaS better than others. Or for this one, I want to go to B because they understand this better, and so on and so forth. Right? But you said, no, I want to go to someone who gives maximum amount of money and maximum valuation because that's my job. But that's not your job.
True.
Abhay, you gave a nice example of an LP asking for 500 million in profits. But what else are you hearing from LPs, especially your global LPs? What's the view on India VC?
Very nuanced answer. I think net summary, people are still optimistic on India, because not because we are great, but because the rest of the world is fucked up. So net, it's a positive view in India, and therefore we'll see more money come to India. But there's a ton of disappointment about what's now happened in 2021, which there was, even the LPs are, I mean, it's not that LPs are seeing the world ahead of us. They are seeing the world through our lenses, through the GP's lenses, but they may have a bigger perspective because they're seeing it through many GP lenses. So they were all feeling very happy in the mid of 2021. Right now, they're very disappointed with us. But overall, I think India is still in a good place. So we should be okay from LPs moving more dollars into India. That's the summary.
Yeah, I think the only thing I'll add is, and we don't, so we are balance sheet based investors. So, but in the internal view that we are taking is kind of very similar, right? The list of investable countries has gone down drastically over the last 1.5 years. Because when you were playing at the edge of the risk curve, even Nigeria looked good, and sort of a bunch of countries in Africa looked good. But then all of a sudden, when you're not playing at the edge and you're playing below the risk curve, the filtered list is probably 3, maybe 4. There is India, there is Indonesia, Brazil because of natural resources, maybe Philippines, Vietnam, something. So completely agree. I think there's definitely a positive view there. The governance, of course, is front and center in a lot of our internal discussions on. So the news does get out, and so everyone reads, and especially the negative news, people read very intently. So that's increasingly becoming a hot topic in our IC memos, I would say.
Got it. Just extending that to global funds investing in India. But do you think it's the same case there? Global funds investing directly into the companies.
So I would say there is 2 flavors there. If I'm a global fund and if I am kind of at this time allowed to invest in public markets, then I don't care, India, US, wherever. Then I would say, boss, this is a liquid public market. It's trading at sort of such a sensible valuation. Should I pay 20 times or 40 times for a private SaaS company? Probably not, and I have that option. Right, and the second one is where you're not allowed to do that, right? And then I think you are thinking. The one thought, and there is 2 sort of opposing forces here. The one thought is that if I'm a US-based fund, flight to safety is very important for me. There's enough interesting opportunities in the US. By the way, US is also looking very solid in this sort of in this at this time. Should I invest there? If I want to play slightly more aggressive, then probably I'll do something in India. So overall, from a global fund perspective, I think much there is excitement, but much less than what it was last year for the country.
Got it. We have a question in the chat here. Had a tough time managing founder expectations around valuations, especially getting them to understand how it impact the next round.
Hey guys,
Any suggestions?
everybody doesn't have to be mute unless Shruti has put you on mute.
Oh, no, not me.
Okay. Why don't you fire the question?
Yeah. So how do you manage founder expectations around valuation?
Conversations, sharing
Yeah.
experiences, sharing good and bad stories. I don't think this is any science to it. You have to do all the usual stuff, but I think now it's easy. People will understand because they'll see many cases where cap tables are broken down because of greed, and so therefore the job. So this was a more relevant question last year. Now it's they'll get managed themselves by the market.
Yeah.
Okay.
Abhay and Ashutosh, just one parameter like capital efficiency. How important is that now? I think it was ignored. I did a analysis last year for SaaS company for my personal. Like it was like the capital invested to era. Even for the best of the best company were not panning out in a sweet spot. So growth, capital efficiency, business model. How has the pecking order shifted, or is it the same? What's going on in the mind?
I think for me, at least at the very top, it still remains the same. I think the product and the team are still number one. Uske niche, there has been a little bit of moving around. So today, probably like capital efficiency is slightly more in flavor or in favor than compared to let's say growth, right? And in the end, it's all a question of sort of can you get to that next stage, next step in your life as a company, wherein you've shown enough with this capital that you're worth someone else kind of taking a punt on. So I mean I don't think that if you're very capital efficient and you have a mediocre product, it still matters. I mean, it's important, but the top two things are top two.
Understood.
Hi, Abhay and Ashutosh. Ansh here. I work at First Check. It's a pre-seed stage fund, so we come in very early. But just to get an idea, for a company that has recently raised Series A, right? How should they go about defining targets? Because eventually they're going to raise a Series B, and they have some metrics in mind, right? That if we achieve this in this much time, that's maybe the sweet spot when we can start raising. Since the market has changed after last year and it's a completely different market now, what do you think a Series A fundraise ke baad the founder's mindset should be to pan out his plan for the next fundraise?
I think very difficult to give a very sort of pinpointed specific answer. It varies a lot from what type of company you are. If you are, for example, let's say a SaaS company, then I think the science is kind of very clear as to when you can raise a Series B round at a time of Series B, what kind of ARR we should have, what kind of churn and LTV to CAC and so on and so forth. And maybe sort of if there is sort of windows there, I would assume you want to be on the right side of that window in today's market. Previously, if you were on the sort of bottom end, still fine. So I think it's so what metrics to choose is difficult to answer because it varies a lot, but how to choose them is, in my mind, is very clear. I think talk to as many people as you can from within your industry, on your board, other people who you respect, and I think in the end, the holy grail of all this is to reach at a level which is a meaningful departure from where you are today, and which just shows that look, there is something extra that you achieve from today. It could be reflected in revenue. It could be reflected in your NPS score and so on. So I think I don't unfortunately have a very specific answer. Abhay, please.
No, it is nuanced, Ashutosh. It's function of the industry. I think there are things which investors at Series B would look, which is in addition to Series A. I mean, just give you examples in SaaS. A Series A company might be have started selling well in India, but the real large market opportunity may be the US. The Series B investor is not going to come unless you show some proof of concept that you've got a few good customers in the US market. So that is important to see. Likewise, if you are a D2C brand and you've got, let's say, the 5 crores of revenue or 3 crores of revenue, Series A investor is coming in and they're happy. But by the time the Series B investor comes in and says, you know what, see, D2C will take you that far. I'm looking for a longer track record or proof of concept. Show me some offline success as well. Unless you sold at least a couple of crores of sales through the GT channel, which is going to be the most important channel for you, I don't believe that you have the capability to build a large company. So Series A, team, product market fit, some things are working. Series B, show me where the larger markets is. Are you having some traction there? And so on. So you have to define those benchmarks in your mind depending on what business you are in. And they're very clear, depending on the business and where you are heading and the story that you are trying to achieve, there will be clear benchmarks.
Got it. One more thing, it's not a follow-up, but I had one more question in my list. So coming to early stage, now again, because the market has changed, do you think companies should ideally be looking for a longer runway right now while raising, as they were doing in 2021? Say if 12 to 15 months was ideal back then, maybe 18 or more than that should be ideal right now. Is that how the strategy should change? And also, is that how we should judge founders? If they have this mindset, then maybe they're reading the market right.
I mean, that's the gist of summary of most of our discussion today, that look, capital is scarce. So extend your runway as much as possible. Unfortunately, at the same time, you will have to show progress. So it cannot be the case that you are stuck at this point now and you'll be here 18 months from now and expect love at that time, right? So it's kind of, as we discussed, it's a fine balance. You have to figure out a way to let that money last for long and at the same time sort of show progress. And the way more people internalize this is that in a world where you had a lot of capital, you kind of go after 5 priorities. But at this time, you should sort of choose the first one or maybe the top 2, which are the most impactful, most ROI generating and so on. And so if you forget the rest and work there, and then that's how sort of you have whatever money you have last as long as possible and still show progress.
Yeah, I completely second that. I think the time for running multiple experiments and projects to show that I have multiple optionalities in my business for the story of yesterday, because investors were dreaming more. You could show 5 optionalities and some investors will pick optionality 1 because they're excited about that. And somebody else may pick optionality 3 because they love that. Today, people are saying, show me the core business where it's going. We'll speak about optionality later. And therefore keep the optionalities there, but no money spent on that. It's a story. I love the story, but don't spend money on it. Make sure that your core is strong and has shown growth till you get to the next stage.
That makes sense. Thanks a lot, guys. Thank you so much.
I have another question. So it's easy to speak with hindsight, but where we were last year, how do you build an internal culture of not giving into FOMO? Most of us on the call have pretty much only seen a bull market. I know Anand's answer to this, we did fewer deals last year, but would love to hear your thoughts.
Yeah, it's very hard. I mean, it's very, very hard to not get that FOMO and not question as to why the rest of the world is doing this and why you shouldn't be doing something like that. And I doubt if anyone can claim that we did not at all get carried away. Everybody did get carried away. In retrospect,
Wait, not just FOMO. I feel that this year it was not because of FOMO, but because you keep listening to so many pitches. You end up investing at my stage just to scratch an itch. कि यार 6 महीने से कोई डील नहीं किया है, $1 ही million का डील कर देते हैं. So it's not even FOMO. It's that bad.
Fair enough. No, it is very hard. But that's where partnership comes into play. Because what happens is one partner goes and meets a company and says, you know what, I'm getting excited about this. Somebody else has to pull you back to earth and saying, "Ye kya dikh raha hai isme tujhe? Mujhe to nahi dikh raha." And those are the candid conversations that versus saying, you are kite flying there, let me kite fly somewhere else. So I think all of us did get carried away, and everybody will point fingers at somebody else saying, oh, they got carried away more than we did, so we are okay. But I think none of us are okay. How do you build a culture is a very tough question. It's conversations, and I guess having some gray hair in the room always helps, because there have to be a couple of people in the room who've seen some cycles. If it's all a very young team, it's harder, because if you haven't seen a cycle, it's tougher to draw comparisons saying, hey, we saw this and the same thing happened this year there, and so on and so forth. So leaning on that experience is helpful. It feels like, why am I listening to this outdated guy? But these cycles catch up and keep coming back all the time. But I can understand the sentiment of the younger guys saying, yeah, you don't get it. The world has changed.
Hey, there is somebody who's asked a good question, Ankita B. If she wants to speak up, or else we'll give it to Kashav.
Hey, Anand, Ankita here.
Yeah, Ankita.
Yeah, so my question is that we have all read it multiple places in blogs that the VC market tends to outperform other asset classes during a downturn. However, the public market multiples at this time, be it in the US or in India, are so attractive for the investment. So how does this materialize in the real world?
I think every downturn is the same. Public markets also crash. So we are not in a very different situation today versus other crashes or downturns of past years. The statement that you said is true, but only for the top decile VCs. It's not a generically true statement.
Yeah.
So overall, if you look at the track record of an average VC, the median VC, it will probably just be as good as the markets.
Abhay, a median VC doesn't ever beat public markets, right?
Exactly.
Rarely beat public markets. Yeah.
So we are in no different situation than the past downturns. So I don't see why the outcome again will be different, which is the top decile VCs will outperform the index, and then most of us will struggle to.
I understand. That's helpful.
I believe
The good news is that the top decile sometimes changes, so there's hope.
That's true. So true. Well said.
So in that,
would it be true, Abhay, to say that every boom bust cycle will produce or see a churn in the top decile?
Oh, absolutely. I mean, go back to history and you see the number of well-performing venture funds who are dead.
Yeah,
absolutely true.
That's the key good feature of a boom bust cycle, right?
Oh, absolutely. Be it consumer internet, be it clean tech, all stages have taken out some of the top venture firms. So I agree. This cycle will also take some top venture firms.
Looks like. Okay, Keshav is there. He will put his video on only when he gets to.
No, I just came in that. No, out of respect, but thanks guys, and thanks Anand for this. Just curious, right? Just to extend that thought, that in case if you are an institutional LP and trying to take exposure to this asset class, right? Then does a fund of fund kind of model or betting on 5 different LPs really make sense, or are you trying to optimize to find the top decile? Because then there is no case for an index on startups then as an asset allocation.
No, I didn't understand the question. If you can just rephrase that. So if you are a LP who's looking to invest through fund of funds, is it?
Or to startups, if I want to take an exposure to startups, right? I mean, so if I was to do it to a public market, right, I could just go for an index, right? And here you're saying that if you spread yourself, right, if you're not in the top decile of VC funds, right, the chances are everything below the top decile ends up really performing really badly, right? So what is, as a LP, or as an institution who wants to take a larger allocation for the balance sheet to, this asset class, do you go around chasing those 3 or 4 top funds, or is there a way to, so because indexing from what you are telling me does not work in that case?
No, it is. I mean, there is a serious chase going on for the top decile funds all the time, with a few bets being placed as saying that these are going to the next top decile over the next, whatever, 10, 20 years. So that's LP's job. Unfortunately, there's so much money in the world right now that it doesn't get exhausted after the top decile, and therefore you have to keep going further and further and further, and therefore average returns keep getting worsened. But it is in the job description of most LPs saying, find a way into Axel, find a way into Sequoia, let's get into these funds. That it is
and Keshav, you also will need to take a few bets on people who are likely to be top decile, because sometimes it's just not possible to get into the current top decile funds.
Right.
And you will have to chase them. A lot of us have actually reached a situation where we don't take every LP who wants to put money.
Right.
And they're reaching there or have reached already, right? So you will have to chase that. The chase is there. It's a true chase. It is sort of how we used to chase founders in 2021 or always, actually.
So just to flip to that, right? The second part of that is venture doesn't scale, right? I mean, we've all going through anti-dilution, we were, have that theme as well. So how do you balance that, right? I mean, suppose at one point of time you're growing, you're making new funds, you've got the best LPs, but the LPs also have a thing, right? Okay, I want to put at least $200 million, right? Or when you start suddenly looking at, say, a $200, $500 million kind of funds, right? As a manager, and I know this is probably not so much for the early stage guys, but just how do you think of it as an asset? Because that has impact on the asset class, right?
So
sorry, go ahead. No, I was just saying that, look, it's no different from us picking companies, Keshav.
Yeah.
Right. I mean, it's kind of very similar. It's if you have 200 million to deploy, you will make some bets which you sort of right off the bat feel, look, this is solid. This is a guy who was the CEO of Flipkart or CEO at sort of Snowflake or something like that, and look, this is gonna work, right? And then sort of you have the next 100, and then you think that off the lot, who is better? So I think that's what they're also doing, right? To Abhay's point, I mean, it's funny, right? There is funds at the top where LPs are fighting to get in, and then ask an up and coming GP, right? How difficult it is for him or her to raise funds. So it's very clear as to so investing in a Sequoia is a very easy decision, even within their ICs, and then there is a sort of some flexibility at the next level.
Thank you. I think just signing off, is it fair to say that nobody got fired for investing in some of the names that you took? Same like no CEO gets fired for hiring a McKinsey, whereas you should be chasing the upcoming 10 who are going to change in this cycle.
No, if your job description is to get into Sequoia, you'll not get fired for achieving your job description. So people get hired from one firm to another, one LP to another, saying you had a relationship there. So now can you try and get us also into that firm because you know ABC in that firm? It's no different from a public manager investing in HDFC Bank, saying top quality bank, top quality asset, you'll not go wrong. So let's invest. But on the other point of scaling, I think the jury is still not out. Andreessen Horowitz is only a 10, 12-year-old firm, and they've shown that venture can scale. Some of the results are TBD, more recent ones, but they've scaled. Tiger scaled to something very different in 20 years. So people are trying to find models to scale VCs as well. Of course, laws of gravity will tell you the returns cannot be the same. So, but it shouldn't be that a VC should always deliver a 45% dollar IRR net. Even a 21 is good enough. So some of the rules are being questioned and challenged, and people are trying different things. Even Sequoia's last fund in 2018, the Global Growth Fund was $7 or $8 billion. So that's some serious scaling. The India funds have scaled. So it is, people are experimenting. There are challenges to it.
Great, thank you. Thank you for the time.
Hey.
I have one last question if we have time.
Hey, I think Ansh, we should 7 o'clock already.
Okay.
There's Hari who has a question. You got a chance.
Cool.
Oh, hey guys. One of the learnings for Sachin Bansal from Flipkart is that he didn't want to take money for his second venture, and he didn't take any outside money. Obviously, he had the money to finance the startup himself. But in the current funding environment or going forward, do you see a pattern, or are you seeing some interesting companies which don't want to dilute themselves? Are there any startups that you want to get into, but they're saying, hey, we don't want external money?
There always are some startups like that.
Yeah.
Zoho and Zerodha are good examples of that. But that level of discipline and that level of maturity is very rare to find. And sometimes the opportunities are large enough that you can't do it yourself. So not every founder is justified in saying, I should not raise. Sometimes it's imperative to raise because you see a larger opportunity. It is a very, very mature mind saying, I don't want someone to come and tell me, influence my life, timelines, IPO, secondary, why should I deal with all of this? So, but it's rare. I don't think many people think like that.
I agree, and a lot of business models also don't allow for that, actually, Hari. So yeah. But yeah, to your point, I think hopefully there'll be many more Sachin Bansals, and hopefully we'll see many more people funding their companies with their own money.
Yeah, it's a great trend. I mean, and I'm really hoping that it'll be successful.
Yeah.
And okay, guys, it's a wrap. I think we're 5 minutes over time. Thank you so much, Abhay, Ashutosh. Always a pleasure.
Awesome.
Thanks,
Thank
Anand.
you.
Thank you,
Thanks,
Anand.
guys.
Good luck, everyone.
Thank
Thanks,
you.
Ashutosh.
Bye.